Hi everyone, welcome back to Be Rich. We have Anand back in the studio with us, so we're here to talk about something interesting. Could the issue of the bank crisis, which is that precipitated thanks to the Fed, been avoided in the US if only if the account holders in Silicon Valley Bank had resisted to the temptation to have a run at the bank and withdraw their cash in such urgency? I thought Anand can talk about the nuances of this situation.
See, I won't blame the Fed for this. When the same Fed was giving money at 0%, and these guys took out the money, these same venture capitalists put their assets, borrowed at 0.5%, 1%, and played monopoly game all over the world
Correct.
with the paper money that the Fed was creating. When for the first time money was transferred directly to the people, people went spent money while these guys were playing monopoly. The price of goods and services went up. And since goods and services prices went up, labor demand went up. Therefore, wages went up. Therefore, inflation went up. So, to cut inflation, Fed had to increase interest rates. So, let's not blame the Fed. It's now reached from 0 to 5. Now, when it reached 5, if these guys had kept their trap shut, they wouldn't even have started the crisis. Let me explain. When the going was good, these guys took big loans at 1%, 0.5%,
Correct.
and all the, especially the housing loans and the credit card loans and the education loans. These were parceled as bonds and sold. And now what? This is sitting in the insurance companies, your pension accounts, everybody has bought them.
Correct.
Now interest rates have gone up. So even A grade bonds of A grade customers have to be marked down.
Very true.
When it was 1%, it was $100. Now a new A grade guy goes to buy, he'll buy at 5%, borrow at 5%.
Very true.
So the old bond has been marked down to 90 cents or 85 cents to a dollar.
Correct.
Now there will be if you go to your insurance company or pension company to withdraw your money, they will be forced to sell those assets in the market.
Correct.
So what is now valued at 90 cents to a dollar and 85 cents to a dollar will dramatically drop to 60 cents, 50 cents to a dollar. Because everybody wants to sell and there is no buyer at the other side.
Correct. Because Fed is increasing interest rate.
Fed increases interest rates.
Correct.
Therefore, new bond rates are higher.
Correct.
And therefore, old bond rates have to fall at a price.
Who will want it? Nobody will want it.
Nobody. And these are all tradable bonds.
Correct.
And these are at very cheap price bonds which you have bought.
Very secure bonds,
Very
but
secure bonds.
at a lower price.
Even if you had bought slightly higher interest rate bonds, there wouldn't have been no problem.
Correct.
If you had bought bonds at that time at 5%, you wouldn't have lost money.
Correct.
But you bought the most secure bonds. They are under pressure.
Yes.
Now, since you asked me about Silicon Valley Bank, I'll tell you what Silicon Valley Bank did. Silicon Valley Bank has most of its deposits, only less than 20% of its depositors have deposits of less than $2.5 lakh.
Very true.
So most of them have deposits more than $2.5 lakh US dollars.
Yes. High net worth.
Okay, $2.5 lakh is a lot of money.
Correct. They famously did an ad also. Only if you have $1 million or above, they're interested in doing business with you.
Yeah. So you basically are ruling out 95% of America.
Correct.
More than 95. The guys who had in Silicon Valley Bank were the rich and the famous and who didn't need the money that was in the bank.
Correct.
Now, Silicon Valley Bank, for its secured assets, had gone and invested in 30-year-old bonds of Government of America.
Yes.
These are treasury bonds. They had invested not in your secure, good customer, home loan, credit card loan. They had invested in government bonds
And
30
Uncle
years.
Sam. Yes, and Uncle Sam.
Uncle Sam, 30 years, right? And they got 1%, which was an extremely good rate. That's why they went and bought long only 30-year-old bonds. Now, these bonds were bought when the Fed was at 0. Now, and you bought it at 1%.
Made logical sense.
The Fed is now taking it to 5.
Yes.
That means this is now worth only $93 to $94.
Correct.
For every 100 has become 93. So there is an erosion in capital, but this erosion in capital is only in paper.
Yes.
It's not on the, unless you sell it, you are not going to realize the loss.
Correct. Only if you want to cash in right now.
If you want to cash in right now, you have to sell it at that loss. If Silicon Valley had kept quiet,
And waited the full term of the bond.
Full term of the bond, they would have got the full money.
Correct. Plus a 1% interest.
Yeah, plus 1% interest. Or if they had managed to hold on for 2 more years and the rates had started to slide again, they would have also, the bond value lost and went
Bond
up.
prices were stabilized.
Like this, it went down and came back.
Correct.
Exact opposite of interest rates.
Correct.
But these rich guys who gamble with other people's money everywhere,
Correct.
they could not wait. When it was their money, they felt palpitations and they felt very worried that this money is not coming back and the bank will sink. And there is a contagion effect. The first two guys who took out the money told them, boss, the bank is
It
losing
took
money.
me 45 minutes. Usually I get it in 10 minutes.
And it
took me 45 minutes.
So everybody in Silicon Valley rushed to get their money out. Now how will the poor fellow pay the money? He has already invested. If he keeps it in this bank, he cannot pay you interest.
No.
So the poor fellow had to sell the.
He had to invest in bonds.
He had to invest, and he had invested the most secure bonds. None of these guys expected inflation. All these jokers were saying inflation is transitionary.
Yes. Even some of the leading Nobel Prize winning
laureates said this.
Yes.
So nobody expected what came them. Nobody knew what hit them. So when the Fed was forced to increase interest rates, the most secure asset became less valuable.
True.
And these so-called fat cats forced the bank to sell the asset.
Yes. Saying, I want the money right now.
I want my money right now.
Yes.
So that fellow had to sell for every dollar worth of bond, he got 95 cents. In banking, your equity is very thin. You leverage it 20 times, 30 times, sometimes 15 times, 20 times.
Very true.
So when there is a 5-6% loss, you are wiped out.
Yes. The domino effect.
Domino effect. If these guys had not gone and pushed Silicon Valley Bank to take their money back at that time, this bank wouldn't have gone down. You won't have this trouble.
And this also spread wider, and Biden was forced into bailing this bank out to prevent the contagion from spreading to
other banks.
Middle class families.
Yes, and now what happened is First Republic Bank got into trouble because everybody started the next guy is in trouble. So now what Biden is saying is that the Fed deposit insurance scheme is for all banks and for all deposits, irrespective of any amount of money. Now this is a rolling credit cycle. If inflation does not drop very fast, Fed will be forced sooner or later to increase by another 0.25%. Because all the market is now betting is inflation has come down, it's below 2 and the Fed is going to cut rates. Fed has publicly committed to bringing the rate at 2%. It's at 6%. So it's not going to come to 2% anytime soon. So there is a good chanceability that another 0.25, 0.5 rates will increase, which will lead crisis to other places. This is not a one-time crisis. So it is very clear, had these fat cats held on to their nerves and given SVB time, it only required another $20 billion. If they had given time Silicon Valley Bank to find $20 billion, they wouldn't have been this crisis.
Okay, I have another curious question. Usually when this kind of crisis comes, the US dollar usually strengthens. But this strangely what's happening this time around is the dollar is weakening. So what does that mean?
This is because the market is expecting that the Fed will cut rates. Poor Jerome Powell, he's really nervous. He's trying everything to tell everybody that there is no rate cut. Read my lips, there is no rate cut this year. The market still believes there is going to be a rate cut here. So if the rate cuts...
So it's like children not believing their parents. When the parents are saying, no more ice cream. They're like, no, dada, there is more ice cream. I know, there is more ice cream in that fridge.
Yes.
He's saying there is no ice cream. No. I'm sure Mama's bought and kept ice cream.
That ice cream is for me.
Yes. Okay. Curiously now, what I want to know is, recently China president went and met the Russian president, and they had a good meeting, and they shared some food, and they shook hands. And one thing which everyone, even it came in CNN, they were talking about it is, wider media didn't pick up is, they're busily discussing, Russia and China, of only using yuan as a currency.
But I'll ask you one question. You ask any Chinese outside China, not inside China, where he'll get thrown in prison. Whether he would prefer yuan or dollar.
Correct. So here's my question. If this is true, if China's Xi Jinping's idea is to take an economic battle to US and hurt the American dollar, and he's trying to destabilize the world thing, move it away. One second. Won't he be better off opening up the yuan into a more transparent
More
currency?
than yuan opening into a transparent currency, you will want a transparent government on top. A transparent democratic
Correct.
government.
Explain to everyone why this will not work.
Because the people want to take the money wherever they go.
They want to know the money is there.
The money is there. They know that the American dollar can be exchanged anywhere.
And that's what Silicon Valley proves.
That's what Silicon Valley Bank proves.
Because if it has happened in China, the same crisis, they would just shut the bank down and say, too bad.
Yes, if this had gone on to China, or what happened in Punjab Maharashtra Cooperative Bank, he said, you bad boys, you don't need the money.
Correct.
So, and in China, they will call out the army.
Correct.
And you will be beaten up.
Correct.
So, there is no fungibility of money. Money cannot move across borders. So, the yuan can never replace the dollar. Thank you for watching. Be rich. If you like this content, hit the like button of my video, turn on the bell notification and subscribe to my channel. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.